In this week's video, we'll review the latest charts and data to help us answer the question, will the April 2nd reciprocal tariffs bring additional pain for investors? We'll be moving quickly, so feel free to use the pause button on your video player. In the first half of this week's video, these are the topics that we'll be covering. And in the back half, we'll be looking at foreign stocks, gold, REITs, utilities, bonds, and consumer staples. Keeping in mind that April 2nd is still the target date for the reciprocal tariffs, let's check in on the XLP consumer staples relative to SPY S&P 500 ratio. This was the chart that we covered on March 7th. The chart is dated March 7th. You may recall on March 7th, we said as long as this ratio stays below this orange line, it's easier to remain relatively patient. And we also said at that time that this white space between the ratio and the orange line told us to keep an open mind about additional downside. If we fast forward to an updated version of the exact same chart, this chart dated March 21st at 2:50 p.m. Eastern Time, we have a chart that falls into the not too bad so far category. Concerns would increase if the ratio starts to move into this area here, and they would increase substantially if we started to take on a look like this, where the ratio gets out here into this white space. Sentiment. Typically, when you see a headline like this headline here in the upper left-hand corner of your screen, dated March 16th from the Wall Street Journal, or this headline on the right side of your screen, also from the Wall Street Journal, dated March 10th, it's time to start keeping an open mind about a reversal in the stock market. Sentiment falls into the same category. Tweet from Bespoke. AAII bear sentiment came in above 55 for the fourth straight week, eclipsing the prior 3-week record that ended in early March of 2009. If you know your stock market history, and if you lived through the financial crisis, if you traded through the financial crisis, that is a shocking statement, because it's telling us that after a 10% correction in 2025, sentiment, based on this measure, is worse today than it was in March of 2009, after the S&P 500 had dropped 56%, after the U.S. government had taken over Fannie and Freddie, after numerous major money center banks went under. And I can assure you the chart of JNK, or junk bonds, didn't look like this in March of 2009. If we compare and contrast the JNK chart here dated March 19th with the look of the identical chart during the COVID plunge, the early stages of the COVID plunge, and the early stages of the 2022 bear market, we can see that the credit markets don't seem to align with these gloomy headlines, nor this shockingly bearish AAII sentiment reading. Once again, telling us to keep an open mind about a wide range of outcomes, including better than expected outcomes. And this study from Sentiment Trader would fall into the same category. Tweet top of your screen, our panic euphoria model crossed below negative 0.27. What does that mean? Historically, 2 months later, 3 months later, 6 months later, 1 year later, the S&P 500 was higher in every single case. 2 months out, median gain 8%. 3 months out, roughly 8% as well. 6 months later, almost 16%. And 1 year later, the average gain, 24%. The median gain, 30%. Again, every single case higher. Not a prediction in any shape, form, or fashion. And also tells us that the next 1, 2 to 4 weeks could easily continue to be bumpy. But it's fair to say it seems like sentiment is overly stretched in one direction. But we'll see how it plays out. Let's take a look at the S&P 500's longer-term secular trend. The secular trend began in this window between this low here in 2011 and this move here that exceeded the prior highs in the rearview mirror from the financial crisis and the dot-com bust bear market. This is your new secular trend here in early 2013. You can see during the strong portions of the trend here, 2013, 2014, the trend where the market tends to trade above both of the blue lines. Thus far, that's what we have in the present day. And if we walk forward from 2012, you can see the market on numerous occasions either made a stand at or failed near those same blue trend lines, meaning sometimes they acted as support, sometimes they acted as a stall area, and sometimes they acted as resistance. And the context in the present day is that during the trading session on March 21st, we were still in the strong trend category because price was trading above both of the blue lines. There's nothing magical about these blue lines, they're simply reference points. So let's zoom in on this period, this period, this period, and this period and see what we can learn. We'll start here with the 14.16% drawdown from point A here to point B here on a daily chart on a closing basis in 2015 and 2016. Point of the exercise. In this case, for the most part, the strong trend look held. The trend wobbled, but it held. When we hit this point right here, the first blue line, the top blue line, if we switched over to a daily chart, this pullback ended approximately 42 calendar days later, so not a brutal amount of calendar days, and the additional drawdown was only 4.7%. In the Q4 2018 case, when we came down here, the move from here to here was more painful. It was almost 11%, but it was relatively short-lived. It was 24 calendar days. So you didn't want to overreact in this case either. Didn't take the market very long to retrace that 10% relative to the calendar. This is early 2019 here. And the COVID crash is our hot knife through butter look. The market barely paused in between the two blue trend lines. That was the bad news. The good news is, once again, relatively short in duration, only 23 calendar days from this window in here down to here. And as we know from past videos, making a stand or having a short stay below an upward sloping 200-week moving average tends to be bullish. And even in the case of 2022, by the time you got down to the two trend lines, most of the pain was in the rearview mirror. You still had a 9.44% additional decline, approximately from this window in here down to this low here. And you did have 157 calendar days of additional pain. But once again, the market made a stand at or near an upward sloping 200-week moving average in red. If we look at all of these cases, the total drawdown, the median drawdown was about 22%, and the additional drawdown when you came into this region here near the first blue line was somewhere in the neighborhood of 10 to 12%, and it took somewhere between 33 and 62 calendar days for the decline to end from here to here. Let's see how that can be helpful in the present day. It's pretty clear when you start walking forward from this low here in 2022 that the market continued to somewhat respect these two lines. They've acted as resistance, they've acted as resistance, they've acted as a stall area, and recently acted as support. So as long as price stays above those two lines, and we're zooming into the present day now, it's easier to stay patient. Again, we're looking at a chart dated March 21st. This is a little bit after lunchtime. So hypothetically, if the weekly chart came down to the first upward sloping blue trend line, that would be an additional loss of somewhere in the neighborhood of 2.5%. If we went down to the second trend line, that would be additional pain in the order of magnitude of 7%. The total drawdown from the peak on the daily chart to this line would be roughly 11.3%. To this line would be 14.55%. And under the more painful scenario, if we fell approximately 10 to 12% from this region in here, that would bring us to approximately a 19.44% decline. And that would be your total drawdown from the daily close to this point down here around 49.50. All hypothetical, because right now we're maintaining that strong trend look, and we really don't have to endure too much more pain, somewhere in the order of magnitude of, let's say, 3% to 7%, to see if we can make a stand, either at the top blue line or near the bottom blue line. Because so far, price action has held above those two lines. Also noteworthy, hypothetically, if our total drawdown ended up being 11% to say 14.5%, meaning the drawdown came to here or here hypothetically, that would still fall into, for the most part, a typical drawdown category. Remember, a few weeks ago, we covered the 75 annual drawdowns from 1950 to the present day, and the average annual peak-to-trough drawdown in the S&P 500 is approximately 14%, and that includes the devastating bear markets. The median decline is about 10.6. If we move those numbers over to this chart, it would tell us if we fell 11.3% hypothetically, or 14.55%, we're still in a typical drawdown region relative to the maximum annual drawdowns between 1950 and 2024. So we don't want to overreact between here and here. And remember, last week, using the SPY chart, which is the S&P 500 ETF, using data as of March 14th, we said we could get an incremental drawdown of approximately 3% to 6% or even 7% here, and that would bring our total drawdown to about 14.7%. That would be this point right here. And why is that relevant? Because if we come down to this line here, you can make an argument logically that the trend from the October 2023 low is still intact. So between here and here, it's relatively easy to be patient. And our total approximate drawdown here would be somewhere in the neighborhood of 14 to 14.5%, also falling into somewhat normal activity for a typical year between 1950 and the present day. Again, telling us we don't want to overreact if we're trying to navigate between a point A and a point B that could be several years down the road. And the base case says several years down the road could be 2034 or 2035. Having said that, if you look at this table and this table, you can pause your video player to do that. We also need a game plan, an incremental game plan for this scenario that says we don't hold here and we don't hold here. And the current drawdown that's been fairly tame, around 10% on a closing basis thus far, could morph into something that takes our $5 million account and slowly sees it erode to $540,000. And those numbers are based on something that happened in the real world. The Dow lost 89% of its value between the peak in 1929 and the low in 1932. Look at this table and this table in this context up here. Thus, if you're a client, based on our current model readings and our current cash levels, and the fact that the market's fallen approximately 10%, in the context of history that says a typical year can fall between 10 and 14%, and the fact that we have an area here, an area here, and an area here, and an area here as reference points that also fall into that normal pullback window, the base case says we probably won't be doing much more defensively between this point here and this point here. In fact, psychologically, we'd like to shift gears based on shockingly negative sentiment and what typically happens after readings like this. We'd like to shift gears potentially to start thinking about redeploying some of that capital. And if the current decline morphs into something like this, we've already taken some defensive incremental action to account for that outcome. We're not making any assumptions about whether or not the market's going to make a stand between here and here. We just know we're exactly where we need to be as of the close on March 21st. Where do we stand relative to that SPY chart that we covered in detail in last week's video? This version is dated March 14th. This version is dated March 21st. Again, allowing for some patience between point A and point B and point C, areas of possible support. Because we know if we come back to this area here, hypothetically, our total drawdown would look something like this here, which falls between this and aligns nicely with this historical data here. Here's the chart for SCHG, large cap growth stocks, that we covered last week. Here's the same chart today. And if we add in some additional anchored volume weighted average price lines, these thin dotted lines, you can see the market made a stand here, market made a stand here, and here. And we're still in that general region today. If you want to better understand the concepts related to this chart and this chart, you can watch last week's video by Googling the title on your screen and our last name, Shavako. In this window here in March of 2009, sentiment was horrible, but justifiably so. And people had also taken actions that aligned with that sentiment. Tons of people lost their jobs, and tons of people pressed the sell button relative to their investments. So the fundamentals in the rearview mirror matched the horrible sentiment. Let's review some history to see how it all relates to the present day. This is the 4-week moving average of initial jobless claims. If you know your stock market history, you know the secular bull market that started in 1958 ended or started to transition at the end of 1968. And that's when we entered that period of secular stagnation that lasted until 1982. Thus, it's not shocking that during that period of secular stagnation, initial jobless claims had a trend from point A to point B, a very unfavorable trend. And we had a recession here, here, and a double dip here and here. So in this case, employers were firing workers. And the stock market was not performing particularly well in this window either. How does the exact same chart look today? People say they're incredibly concerned and incredibly pessimistic, but thus far, the actions of business leaders don't really align with the sentiment. This is the exact same data set, the 4-week moving average of initial claims. Last week, it was 227,000 within the context of a U.S. population level that is much, much higher than it was in 1968. And yet, when all of this started back here, initial jobless claims were hovering around 200,000. The last reading we had was 227,000. If this starts to morph into something that looks more like this, concerns would increase. Here's the big spike when a lot of people lost their jobs during COVID. And as a reference point, the approximate population of the U.S. in 1967 was 200 million. 2025, approximately 347 million. We still had initial jobless claims of only 227,000 this week, and thus we really don't have anything like the data set shown on your screen. How about credit spreads? This is a chart that we used earlier this year. I believe it came from January. This is the spike in fear here during the dot-com bust bear market. This is the financial crisis spike in fear. This is the bear market here in 2022, and this is COVID. If we started to see a spike like this, or this in the present day, the answer is no. In fact, we still have a clear downtrend from that high in 2022. Yes, spreads have picked up a little bit, but not in an overly concerning manner. And that aligns with the chart of JNK that we've already covered. And if we looked at a weekly chart of high-yield bonds during the trading session on March 21st, you can see we've still been making a series of higher highs since October of last year. We really don't have a breakdown like this or a rollover look like this that we had. We could see it, put it in a model in January of 2022. The good news is the VIX was down approximately 11% this week. The bad news would be it's still hovering around or trading above a flattish 200-week moving average, telling us to keep an open mind within the context of that April 2nd date. And it's important to have reference points, areas of possible support below price, because we don't know if we've reached max tariff fear yet. It may come in the coming weeks. At some point between today and, let's say, June, the fear in the news cycle relative to tariffs is going to become less bad, most likely. And if it doesn't, then the probability of taking out this line, and maybe even this line and this line would increase significantly. So the market will help us with that. And how is it possible that the news cycle or the news will become less bad? Well, this is all about negotiations. You're putting the reciprocal tariffs on, and the hope is that everybody will take their tariffs to zero. So it's possible incrementally some good news relative to negotiations will start to trickle out between today and April 2nd, and maybe between today and June of this year. That's not a prediction in any shape, form, or fashion, but it's absolutely a possibility. We don't need the tariff news to become perfect. We just need to get past maximum fear. And we need to see some better tariff news start to be sprinkled in with the bad news. That may or may not happen. All right, let's quickly look at these charts. We all know that we want to invest in things that move from the lower left to the upper right. Those are uptrends. Yes, foreign stocks have been outperforming significantly in 2025. But as you can see, this is a global ETF, and then you remove the United States, so foreign stocks, relative to the S&P 500. Hard to make an argument that this trend has flipped from a downtrend to an uptrend. All of this is taking place below a downward sloping 200-week moving average. This is VEU relative to SPY. And one of the stronger ETFs, and we do have all of these ETFs on our radar, we follow approximately 350 ETFs. We're looking at all of them all the time, typically several times a week in this environment. European financials, they have done extremely well early in 2025. However, EUFN relative to SPY, the monthly chart, if we look at the trends that began in 2013, we're still below all of these downward sloping anchored weighted average price lines. If this ratio can get out into this white space here, that would be very, very impressive. If this ratio can get out to this white space here, and more importantly, if that 200-week moving average can flatten out and or turn back up, that would be impressive. All of that may happen very, very soon. It just hasn't happened yet. Gold. We're not down on gold in any shape, form, or fashion. We own it, but we don't want to be over trading. If you look at the ratio of GLD relative to SPY, they've basically been duking it out with no clear leader going back to January of 2021. And even if we exceed this high here or this high here, which for the most part we've already done, we've got this massive gap on the chart here to contend with. So the good news is for gold, we are above the 200-week moving average, and it looks like it's flattening out and trying to turn up. It gets a lot easier to add to our existing position if we can clear this gap here. And if we look at the AWAPs going back to 2013, which is relevant because that's where the secular trend cleared important highs for the S&P 500, the ratio of GLD to SPY failed at that line during the COVID rally. We're still below that line, and we're also below the line that's tied to this point here where we hit maximum fear in February of 2016. This is where the S&P 500 bottomed. That line acted as resistance in this window here, here, support here, resistance, and we're testing it now. Gold becomes a lot more attractive relative to stocks if we can get out into this white space here. How about REITs relative to the S&P 500? We haven't made a higher high above this high. And the last thing we did was make a new lower low. Chart dated March 21st. IYR relative to SPY. You can see during risk-off periods, it's not unusual for XLU to outperform SPY, but it really hasn't done anything to break the long-term downtrend. And yes, bonds have also outperformed, but we could have said that here. We could have said it here. We could have said it here. We could have said it here. And in these cases, the ones in the rearview mirror, eventually the gains were fully retraced, telling you that you'd have been better off staying in the stock market rather than trying to trade in and out of bonds. Thus far, we haven't even made a high above this high from July of last year. That would be a good first step for the bond bulls relative to stocks. Consumer staples underperformed SPY this week by 0.73%. And this ratio has also not really come close to exceeding the fear high from July of 2024. And all of this move here in 2025 is occurring well below a downward sloping 200-week moving average. Really haven't seen any significant move on the chart of XLP relative to XLK either. XLP underperformed by 0.24% this week. If we look at the AWAPs of IUSG relative to VU, this looks like a pullback within the context of an uptrend that began here in early 2023. If we look at IVE value relative to XLK, this is the current bull market in here. This is where XLK bottoms relative to value stocks early in 2023. The NASDAQ bottoms right here late in 2022. And all of the counter trend moves in this ratio have stalled below these lines. So far, that's the case in the present day. If the ratio can get out into this white space, then we would learn something about bearish probabilities on a relative basis for XLK relative to IVE value stocks, which is very, very similar to VTV. And if we look at SCHG in isolation, hard to make an argument when we look at it from this perspective that the trend from the October 2023 low has been broken. We held here, 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 and we're holding thus far. And if we don't hold, we have an area or band of possible support relatively close by. Not a lot happened this week. The S&P 500, for the most part, was flat. It was up 0.5%. It was down for the week during the session on Friday, and then it rallied intraday. But the good news is this downward momentum has finally started to dissipate in some manner. So what would we be looking for if this chart moves into this area here or here, meaning we make a new low for this correction between now and, let's say, April 2nd? In the event that we haven't reached maximum tariff fear yet, what we'd be looking for and what we would hope to see is bullish divergences. Maybe market breadth that doesn't look as bad as it did here. Right now, we're still holding well above these upward sloping blue lines, which, based on the longer-term chart of the S&P 500, looking all the way back to that low in 2011, that's a good sign. Thus, we know where we are, we know what we'll be looking for, and ultimately the market will help us answer the questions that we have in the present day. When will we hit or have we hit maximum tariff fear? When will the news or sentiment on tariffs become less bad? When the market starts to improve. And if the market doesn't improve, then most likely we haven't hit maximum tariff fear, nor has the news cycle improved in any shape, form, or fashion. And we all know, regardless of how it plays out, the only way that we can use all of this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Reciprocal Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.